Mortgage rates sit at 6%, and the median home price in the US just hit $400,000. To figure out who can actually survive those numbers, we need to calculate exactly what salary safely affords a house today. This table shows the gap between the bank's math and reality. Using the 28% gross rule, a $100,000 salary means the bank approves a $2,333 payment. But this ignores income taxes, 401k contributions, HOA fees, and maintenance. Lenders only care if they get paid back. Maxing out your budget based strictly on their gross approval limit is a mathematical trap that almost guarantees you end up house poor. A much safer framework is capping your total housing costs, meaning mortgage, taxes, insurance, and HOA, at 30% of your net income. Net income is the actual liquid cash hitting your bank account after taxes and retirement deductions. It represents the money you really have available. When you run that same $100,000 salary through the 30% net rule, your maximum housing budget drops dramatically. The numbers are a lot less forgiving. You have to accept a harsh trade-off, buying less house than the bank says you deserve so you maintain total financial security once you move in. This scorecard outlines a $250,000 house. With 20% down, you need $50,000 cash for a 6% rate. Including taxes and insurance, your cost is $1,600 monthly. The bank requires $68,000 gross, but our net rule demands $85,000. With the median savings in America sitting around $8,000, handing over $50,000 in cash is an enormous hurdle. Many buyers choose to put down 10% or less to bypass that initial block. Putting down less than 20% triggers a mandatory fee called private mortgage insurance, or PMI. PMI is a sunk monthly cost. It builds zero equity for you, existing entirely to protect the lender if you default on payments. At the entry level, you face a strict choice: wait years to save cash, or accept a permanent monthly penalty to enter the market immediately. Moving up to the $500,000 mark puts you slightly above the national median home price in today's housing market. This $500,000 house requires $100,000 cash for 20. Your housing security now depends entirely on both partners maintaining high-earning jobs without a single interruption. On the coasts, $1 million buys an average house. You need $200,000 cash down to carry a $6,000 monthly cost. This demands $20,000 in net monthly income, pushing your required household gross past $320,000. Additionally, any mortgage at this level requires a jumbo loan, which demands stricter credit scores and much larger cash reserves. Living in a high-cost area forces you into the top 5% of U.S. earners, fighting heavy tax friction just to afford an average home. The $2 million tier excludes 98% of households. You need $400,000 cash up front for a $12,000 monthly cost. Keeping this under a 30% threshold requires $40,000 in net take-home pay, translating to a massive $700,000 gross annual income. At this tier, meticulous budgeting is completely irrelevant. The only variable that matters is whether you are employed in an elite, hyper-earning profession like specialized medicine or tech leadership. This decision tree maps out the rigid math you cannot fake. Earning under $100,000, target the $250,000 tier. Dual incomes making $150,000, treat $500,000 as a strict ceiling. A $1 million coastal baseline absolutely requires a $320,000 gross salary. Reject the bank's pre-approval limits. Rigorously calculate your budget using the 30% net rule, and willingly accept the trade-off of buying less house today. It is the only way to guarantee your wealth and peace of mind tomorrow.